Welcome to the Broken Pie Chart Podcast, episode 79. I'm your host, Derek Moore. Today, I'm going to talk a little bit about stock splits. Do they matter? Are they similar to dividends? And there's a lot of sometimes confusion about stock splits. They used to actually be more prevalent. I remember in the 90s, it always seemed like when a stock got over a certain amount, companies might split it. They might split it 2 for 1, 3 for 2. Used to see some weird ones like some, 5 for 4s, 3 for 1s. But there was some news about a big company named Apple that announced something. And also, if Apple does split their stock, it's Apple, by the way. If Apple does split their stock, does that really mess up the Dow Jones Index? And I'll get to more of that. And finally, as we mentioned, I guess about 2 episodes ago, Tesla did theoretically meet the criteria to get into the S&P 500. Have not heard anything whether they'll get in or not. And they actually, I don't think they have that meeting until sometime in September. So more, we'll see what happens on that, but who knows? And will it matter? I don't know. I don't know if it will. So Apple this week reported earnings. In fact, the Google, Apple, Facebook, Amazon all reported higher than expected. I'd have to check whether the higher expected was on a reduced expectation, though. But by all accounts, they really did well. And Apple's board announced the authorization of a 4-for-1 stock split. Now, you might remember Apple at one point had a 7-for-1 stock split. So is that a big deal? What does that exactly mean? Well, yes and no. They used to, as I mentioned, in the 90s, it was sort of one of those things. Companies used to not like to have their stock price get too high. And the theory was that if your stock price was too high, then, a lot of people couldn't. It wasn't accessible to a lot of people. And years ago, there used to be, you probably heard the term odd lots. An odd lot was a denomination of shares less than 100. And years ago, I believe it was more money to trade in odd lots and a little more inefficient. Even today, odd lots are not reflected on a level 2 quote system. But that was sort of the idea. And then, of course, you had although Berkshire Hathaway theoretically never split their stock, they only created, might remember the Berkshire Hathaway A shares, never split. They created B shares, and that was, I think they were seeing on CNBC, that was a response to, there was going to be a unit investment trust that actually created a tracking stock. In other words, you could buy, instead of having to spend $30,000 for one share, you could buy a tracking, kind of a quasi ETF. Although back then when they came out with it, ETFs were in their infancy. Would have been maybe a unit investment trust. But of course, then you have Google. I don't think has ever split their stock. Amazon's never split their stock. As I mentioned, Apple did that 7-for-1. And so if Apple hadn't have done that, their stock closed a little over 400 last week. Their shares would be, 2,800 plus. So, but again, the theory was more interest, maybe more retail interest. So not everybody can afford a full share of, Amazon at over $2,000. So if you split it, or Apple, at 700, so you split it. The reality is, though, that I don't want to call it a placebo. But in some ways, I think stocks, I remember this from the 90s, when they released a stock split, it seemed like they ran a little bit, meaning went a little bit higher, and people would think, hey, this is great. The stock's going to be lower, more people can buy it. Important thing to understand, though, is that institutions still make up the majority of investing on Wall Street, not the retail traders, not the retail traders that you're reading about in the Wall Street Journal and are opening, Robinhood accounts. The other thing too is, Fidelity, Schwab, Interactive Brokers, they allow fractional share trading now. In Schwab's case, they allow it on the S&P 500. But if you didn't have enough to buy a full share of Apple, and you only wanted to buy $5 worth, you can do that now with Schwab stock slices. So the importance of actually having a lower price stock to make it make it appeal to retail traders isn't quite as much. But here's the thing. It really doesn't matter that much. And the reason why it doesn't matter that much is that although you're going to have more shares outstanding and the stock price is going to be lower, in theory, nothing changes. In other words, Apple's market cap as of the close Friday was $1.84 trillion. How do we get that? We take the shares outstanding, which is 4.33 billion shares, times the price, which was $427.44, and you get the 1.84 trillion. By the way, if Apple or Microsoft or what's the other, Amazon, a couple others are in the 1.5 trillion or higher club. Big question is who becomes the first $2 trillion market cap company. But the reality is that if, let's say, for argument's sake, you split it 4 for 1. Well, not for argument's sake. If so, and again, the board has authorized this. I don't think they've announced it yet. So they've authorized to actually do the split. But if they do a 4 for 1, well, instead of having 4.33 billion shares outstanding, that would be multiplied by 4. So now you'd have about 17.2 billion shares outstanding. Does the market cap change? No, it doesn't. And the reason why it doesn't is that simply the 427.44 would get divided by 4, and that would be your new stock price on that first day. And so there's more shares, but the price is lower, but the market cap in theory is the same. So what else changes? Well, they just reported earnings of, I think it was over, it looks like over the last 4 quarters, about $13.16 per share. Remember, earnings per share is just the net income divided by the number of shares outstanding. So yeah, the earnings per share would get cut by 4. But when you multiply it by the number of shares outstanding, it's still the same net income. And it's also important to note that on any charts or, if Apple's all-time, I think it's right around its all-time high. But if it's all-time high, let's say it's 427.44, it's all-time high, assuming the stock didn't move one bit and they did actually not only authorize, but then implement the stock split, you would expect the all-time high would be 1/4 of that. Remember, they already split 7 for 1. So all the charts and everything, that's all split adjusted. Same thing with the earnings, same thing with everything. So all that stuff gets split adjusted. And same thing with dividends. Right now they pay about 20 cents a share, I think is what I'm seeing here on the screen. And so in theory, 4 times the amount of shares, 20 cents divided by 4, 5 cents per share dividend, assuming they don't, do any changes or anything like that. So not a lot. It actually doesn't really make a difference. And it is a little bit similar to a dividend. Now, dividends, let's say that a stock is trading at 100 and they pay at a $1 dividend. In theory, the stock should have its price reduced to $99. Why? Well, they're paying back cash to shareholders. They're doing a distribution of profits or of free cash flow, right? Now, that's sort of in a vacuum. We realized that even, if the market was closed and all they did was reduce the share price by the amount of dividend, you would expect that. But the reality is buyers and sellers, not only do you have the dividend adjusting the share price, but you also have buyers and sellers. So it never quite works out quite that way. But the dividend's the same thing. And that's why a lot of people are like, hey, should I buy a stock right before the dividend? Well, in theory, if you buy the stock, the dividend gets paid out. You just reduce the retained earnings by that much. Same thing for a split. You're like, oh, I better go buy 100 shares of Apple because then I'll have 400. Remember, it's going to be 1/4 of the price. Anyway, that was I thought that was interesting, and it's interesting because we really haven't seen a lot of big companies or really popular companies do stock splits, and it always seemed like in the 90s it happened again and again and again. But there is some big implications for the Dow Jones Index, and I think this is actually kind of a big deal, just in how it's going to alter the weighting. So you might be familiar with the S&P 500, the NASDAQ 100. Those are market cap weighted indexes, meaning, a company at 1.84 trillion in market cap, number of shares times the price, is going to have the most impact on the movement of that index. And most indexes are market cap weighted. Dow Jones is not, though. The Dow Jones is actually price weighted. And so I think just pulling some data here towards the end of last week, Apple made up little over 11% of the Dow Jones. It was the highest weighted company. So, and their market cap is higher than anybody else in there. So, just looking at this, Microsoft is close, but it's a price weighted index. And so if you do a 4-for-1 split on Apple and you cut the price by 1/4, they'll actually go, assuming nothing else changed. By my calculations, they'd go from an 11% weighting in the Dow down to probably around where Nike is. So Nike closed, maybe Nike, Travelers, or Disney, which ranges, 2.5% to 3% weighting. That's quite a bit of difference. And just to clarify this point, when you have an 11% weighting in the Dow Jones, it means that whatever change in price of your stock or Apple stock, that accounts for 11% of the index. And so you could have a couple stocks really drive the index. And that's why you hear on CNBC that, the Dow Jones would have been down this much had it not been for stock X, or it would have been up had it not been for stock Y. So this, I don't want to say it's going to mess up the Dow, but it's going to change the weighting quite a bit. And I don't know why they haven't changed from a price-weighted index to a market cap-weighted index. Pfizer was I think they're only like 1%. Remember, the Dow Jones is only 30 companies. It's not a lot of companies. But they were about 1%. They were the lowest weighted stock based upon the stock price. But let's say Pfizer decided to do, a reverse 1-for-20 stock split, meaning they reduce the shares. They could become the highest rated or highest weighted stock in the Dow Jones, and they would have the most sway on the price of the index itself. So I thought this was kind of an interesting side note, and a lot of people, when they think about the market, they think about the S&P 500. Dow is only 30 stocks. It's not as representative of, in the old days, it was the Dow Jones Industrial Index. Now, of course, you have Visa, and you've got Microsoft and Apple, Intel, number of, Cisco, number of different companies. They aren't certainly all industrial companies. But this weighting is going to change quite a bit. And so as far as I know, the board authorized the stock split. I don't believe they've had an announcement yet of when they'll actually do it. So the way that works is first the board authorizes it, and then they could actually implement it. All right. So, but again, nothing really, in theory, nothing really changes when you split a stock. It just, the number of shares increases, the price drops, and the market cap in theory stays the same. Same thing if you do a reverse split. A reverse split is just instead of adding more shares, you reduce the shares. So if a stock was at 100 and you did a 1-for-10 reverse split, well, what would happen? The stock would go to, $1,000, and the shares would be decreased by a factor of 1/10, right? but the market cap would be the same. So anyway, keep this one pretty short today. That was kind of in the news. Got a couple questions about that. A few people asked me, hey, if they do split their stock, is that something I should buy? The reality is there's little or no difference in the long run. And I think there's some studies out there that actually show whether or not it's that quote unquote placebo effect. And again, with fractional shares these days, you can go on Schwab and buy $5 worth of Apple using their stock slices. So anyway, keep it short for now. We'll be back next week with a longer episode, and we'll talk to you then.